Happy Friday, everyone, and welcome back to Open Exchange TV. Hope you've had a fantastic week and getting ready for Thanksgiving. Joining us, as always, on Fridays is Jay Pelosky. How are you, Jay?
Good, Scott. Getting ready to have some turkey.
Yeah, well, I'm actually cooking this year. I think we've got 17 people for Thanksgiving dinner/lunch.
Yeah, I'll be over at what did you say, 2 o'clock?
Whenever the games are on, mate, that's when we're going to have food cooking, that's for sure. But as it always is, when you've got a lot of family members together and so forth, there can be a little bit of a tug of war. And somehow that actually goes together with the title of your musings.
Oh, my God, you're so good. You're getting so good at just dropping those things in there. Yes, you're correct. The title this week, Tug of War. So I got a lot of good feedback, actually, on last week's title, When the Levee Breaks. A lot of Zeppelin fans out there.
Yeah, there's a ton of them.
They represent it. Yeah, I heard from numerous people about how they love that song and love Zeppelin and all the rest of it. So no musical tie-in this week, but Tug of War, which to me is really, on the one side, you have the Fed and its army of speakers, right, as we've seen this week, and the bearish investment community. They're on one side. And then I argue in the musings that on the other side is reality, and the reality of declining inflation in the US, right? We had October's data, then we had the PPI data this week. We have the European energy situation continuing to be much better than expected. Warm weather, typically storage levels in Europe are about 80%. At this time of year. Instead, right now, currently over 95%. And then, of course, we've had multiple readouts out of China post the PPC Congress, where President Xi got his third term. You know, readouts on ways to support the property sector, readouts on ways to kind of move around zero COVID a little bit. And so remember, those were the big three issues that we talked about way back in the summer as our second half keys, right? The pace of US inflation's decline, the path of European energy prices, and the ability of China to move off COVID, move off zero COVID. And that's the reality. And the reality is that all three of those things are starting to work and starting to manifest themselves. And so to us, this is going to be the tug of war, and whoever wins the tug of war is going to set the direction of asset prices in 2023.
Well, it's interesting. Like, we've talked a lot about your outlook for 2023. Everything's constantly changing. Before we got online, I talked about like COVID having mini breakout again in Australia, the cruise lines going back to masks in crowded environments. What is your impact looking like for 2023 now? What's changed?
Well, I mean, it really isn't a question of changing. It's a question of reinforcing. And right, our title for 2023 was Stability Ahead with a question mark, as you astutely noted when we talked about it, I think now 2 or 3 weeks ago. And so, you know, that stability is predicated on these three issues behaving. Inflation continuing to come down, European energy situation being dealable by the Europeans without creating a big recession there, and then China finding ways to both prop up its property sector and move off zero COVID. And so the way I see it, the last couple of weeks have been supportive of that across the board. Again, reality, not just like opinion, but reality. Inflation numbers were better than expected. You know, the path to lower inflation we seem to be on it. JP Morgan, for example, reports that they expect 4% inflation annualized in Q4 of this year. That's compared to 10% inflation at an annualized level in the first half of the year. Pinecone Macro, a group we like a lot, think to really do good work. They noted that the last 4 months inflation annualized is running at a 2% pace. So to us, the inflation picture is continuing to improve. We expect that will, continue as we go through 2023. The European situation, as we touched on, I think is better than people thought. And we have finally gotten that bounce in European risk assets that we've been looking for. Remember, we wrote a piece, Musings, titled "Things I Don't Understand," right? And one of them was why European risk asset prices hadn't moved, even though energy prices had collapsed down 60%. Well, that's finally happened over the last month. Europe, the best performing region in the world, up about 14% over the past month in local currency terms. And then probably the biggest surprise, Scott, over the last week or two has been how quickly China has changed gears coming out of the People's Party Congress. President Xi got his third term, so it seems pretty clear that he wanted to wait, make sure everything got done, and then shift policy. So we've seen 16 policy measures to improve the property sector, perhaps most importantly, allowing the developers to access pre-sales funding. That's really the key point there. And then the second is, I think, 20 measures to help improve the success of the zero COVID approach. And so I think it's important to know for investors that, we're not looking for the Fed to make a big public statement about how they're pivoting, right? We don't expect the Chinese to make a big public statement about how they're moving off of zero COVID. But the reality is those things are happening. Arguably, the Fed is already pivoting away from the front-loaded 75 basis point hikes we've seen for the last 4 Fed meetings. We'll learn more in the next couple of weeks. Clearly, China is moving, and so we have to kind of read the tea leaves. And I think importantly, recall that for us, the big issue is the dollar, right? We think the dollar is the big loser to stability. As things become more stable, money is likely to flow out of the U.S. dollar, and we got a taste of that over the last couple of weeks. I think the 2-week change in the dollar was the most aggressive since 2008, and the dollar is still massively overvalued, and people are massively long U.S. assets, particularly foreign investors. And you have a situation where U.S. equity outperformance versus the rest of the world is at an all-time high. So there's a lot to suggest that as inflation comes down, interest rate differentials shrink between the U.S. and the rest of the world, as stability becomes more manifest and the crises of 2022 ebb rather than continue to negatively impact 2023, the dollar's got tons of room to fall. And as that happens, the rest of the world catches a bid, and we have a wholesale asset allocation shift away from the U.S. And I think that's really the main message that, as we look for this year of stability, one of the keys from an investment perspective, we think, is dollar weakness leading to the beginning of a multi-year trend of non-U.S. equity outperformance.
It all sounds like you're looking more like for a soft landing, Jay. Like I think you write in your musings, like you're referring to it as a middle way. Like, how does the soft landing look?
Yeah, well, that's a great question, right? It's kind of like stagflation or some of these other terms that are, tossed around by people, but without any definition. So it allows everybody to kind of be semi-correct, right? So let's put some definition around it, right? Soft landing, or what we here call the middle way, is the path between high inflation and recession, okay? And so we wrote about the middle way when we came back from summer vacation in August, because the place where we rented up in the Catskills, the street name was Middle Way. And it was just such a coincidence to me that I had to write about it. So that was when we coined the middle way. That was in August. And again, I think, not to pat ourselves on the back, but I think the trend of activity since then kind of supports the idea of the middle way. and you have a resilient U.S. economy, right, driven primarily by a cashed up consumer that still has well over $1 trillion in pandemic savings to spend. You have a corporate sector that is robust, no sign of big credit worries. In fact, credit spreads, U.S. high yield spreads have narrowed by 100 basis points since the peak in July. And you have banks that are in perfectly good, robust shape, making billions of dollars on a quarterly basis. So there's nothing like the imbalances that existed in 08 or 01. And we continue to push back hard against the idea that we're going into a 2001 or 2008 environment. But let me just tell you, read a couple of things that I put in the musings that show where the rest of the market is, okay? So our view of the middle path, while others are moving towards it, for example, Goldman Sachs and JP Morgan, both have come out saying that they don't expect a recession in the US next year. They do expect inflation to decline. So they're moving in the direction of the middle way, but the consensus is clearly for something else. And so let me just read you something from Bank of America's Fund Manager Survey. More than 90% of money managers surveyed expect stagflation, there's your word, in 2023. Tail risks include geopolitics and a systemic credit event. An absolute zero, listen to that, Scott, an absolute 0% sees a Goldilocks or soft landing percentage or possibility, while 77% expect a global recession. So that's the consensus mentality. Here's another good quote from a Bloomberg article. It's been a miserable year for the global economy, but things can always get worse. Things can always get worse, okay? But our argument is that things can get better. And so I'll leave this point with a quote from Pantheon Macro, who I like. The pace of rent increases have peaked. Our charts suggest that the steep drop we expect to see in core PPI inflation will drag down the core PCE measure, that's the one the Fed pays attention to, faster than the market and the Fed expects. So that's where we're at. We're not in the camp of stagflation. We're not in the camp of global recession. We don't believe it's Goldilocks to say that there's a middle path, but that's the path that we see the global economy and the US economy moving to. And so at some point, the bears, continuing to expect this big earnings decline and this another big leg down, at some point, in our view, it's a when, not if, the bears are going to have to capitulate.
Well, you mentioned Goldilocks in there, or from Bammel does. Like, it seems like there's a lot more than 3 bears.
Yeah, I'd say there's more than 3 bears. Again, from the Fund Manager Survey of Bank of America, investors are 2 standard deviations underweight equities and 2 standard deviations overweight cash. The long dollar is the most crowded trade for the 5th month, and the dollar is at an all-time record overvaluation, according to Bank of America. So yeah, there's an awful lot of bears. Another data point would be the record put-call ratio from the CBOE just came out 2 days ago, 1.46, well above even the lows of 2008. So people are bared up big time. And by the way, it's not even limited to equities. The short position in the 2-year Treasury note, for example, which is a key note, is at a record level. Again, record level. So record shorts in the short end of the Treasury curve, record shorts in US equities, 2 times overweight cash. I mean, there's an awful lot of money on the sidelines that I think is going to start to get nervous, particularly as we get towards the end of the year and start thinking about 2023. If there's a sharp move higher as we enter 2023, I think investors are going to be very leery about wanting to be behind the performance 8-ball right out of the gate, right? This year is going to be a write-off, right? No one did well, or very few people did well. Very few indices did well, so there's not a lot of pressure on people. But it would seem to me that as I write in the Musings, dare we say, buy the effing dip. Can we say that again? I mean,
you can say that. That's no problem at all saying that.
Okay. Well, I didn't use the big word, but
all right. So listen, as we wrap up here, let's stick with that whole nursery rhyme thing. All right. We want good feelings as we go on the end. We're having a 2-week break from seeing you, Jay, because Thanksgiving is going to be next Thursday. No show Friday.
No show Friday, buddy. Going to be like on the couch watching football with a turkey leg in hand.
Well, US versus England next Friday, and the Soccer World Cup as well, or Football World Cup, depending on where you are in the world watching us.
Yeah, well, it's not football.
Let's take it all in. What does all of this mean for markets? And I want a good story to finish off. I want a good nursery rhyme.
Well, I think, as I write, the setup from a constructive point of view is pretty good, right, from our angle. The big three issues, U.S. inflation, European energy, China zero COVID, all clearly moving in the right direction. The Fed, ECB, they're going to be data dependent, and the data should be supportive of declining inflation. Investors are badly off sides and will want to avoid entering 2023 behind the performance 8-ball, right? Seasonality, very supportive. Cycle in terms of where we are in the third year of a presidential term, midterm year, et cetera. All that's very supportive. High nominal growth, which we've talked about ad nauseum, continues to support the top line. Q3 data, US sales were up 12 year on year. European sales, Scott, get this, European sales up 26% year on year in Q3. So there's a lot of decent news out there that we think can propel investors off the sidelines. We think the risk reward is increasingly in favor of being rewarded for taking risk. All that money on the sidelines that we mentioned just a minute ago, investors 2 standard deviations overweight cash, that's going to prevent a big drawdown in our view. That money is going to be put to work on buying the dips, as we touched on. So for us, again, I finish up with the dollar. The dollar is the key. We continue to expect dollar weakness, and therefore our big bets are overweight non-U.S. equity. We continue to be long credit. We like high yield in both the U.S. and in emerging markets, and we continue to think commodities are going to do well. Most commodities have very limited inventories. The global economy is unlikely to go into recession. China is likely to start growing faster. The U.S. likely to avoid recession next year. Europe recession, should they have one, will be mild. So we like the commodity space as well. And bottom line is, we think there's opportunity out there, and arguably a lot of opportunity. And so we think the tug of war is going to be won by reality, and the reality is going to be better, more resilient U.S. economy, more resilient earnings outlook, and a favorable environment for investors.
Well, a great note to wrap up in there, Jay. Thank you so much. Listen, enjoy Duke football, enjoy the World Cup. Just remember that the beer ban does not count if you're on the couch. You'll be okay. You can have a cold beer watching that as well. Have a great break and have a great time with your family, okay?
Yeah, thanks, Scott. You as well. Whatever your sport is, enjoy it. Happy Thanksgiving. We all deserve to take a little break. It's been a pretty tough year. So still much to be thankful for, of course. And let's remember that as we enjoy Thanksgiving with family and think ahead to a better 2023.
Thanks very much, Jay. For everyone watching, good luck investing.